This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, I'm Alex Perny, and today we are very pleased to welcome on David Wolcott, CEO and founder of Pantheon Investments. And we're going to be talking about a few different avenues of interest today, and some things that are very kind of near and dear to my heart with portfolio construction, as well as some other interesting things centered around different types of investments, but specifically also kind of giving a good nod to private credit and oil and gas, which are two things that I highly encourage people to look at when it comes to putting together a well-rounded strategy. One, for some of the really interesting tax benefits and different opportunities that oil and gas can offer, and really some of the interesting and amorphous aspects of what private credit can be. Because it's not just simply buying debt rolls or different tapes of different things. It can be a lot of different interesting things that go into the private credit markets. We've had a few different guests on here as well. I know we just had a great guest with BIP Capital on to talk about some aspects of private credit that they do in the private equity markets. So again, really interested to kind of get your take on a lot of this, Dave. If you wouldn't mind, give us a little bit of background about yourself and kind of how you came to be in your current position with founding Pantheon Investments.
Yeah, you bet, Alex. First of all, grateful to be here to connect with you and your listeners. And probably like a lot of listeners out there, I was raised in a middle-class family in Connecticut, and I was told that the recipe for success was go to school, get good grades, you're going to get a job, and life would just work out, right? So I kind of followed down that traditional and conventional path. Had the opportunity to go to George Washington in D.C. and then do the ROTC program. And shortly thereafter was in the Marine Corps and had the opportunity to serve my country, which was a phenomenal experience. Got to travel the world, become combat tested, and just see some amazing things and really learn interesting things they don't teach you anywhere else in the world, such as leadership, teamwork, and integrity. And shortly after the Marines, I transitioned into the tech sector, into corporate America, and I quickly became kind of frustrated with that really corporate machine and the bureaucracy of which, how things kind of moved. And at the same time, my wife and I were raising a family. We had an 18-month-old running around kind of telling us what to do. And on October 24th, 2000, Alex, we literally welcomed triplets into the world and quadrupled the size of our family. So I've just got to tell you, for anyone who's a father out there, a parent, right? The first thing that was going through my mind was, how am I going to, really provide for my family? It's estimated at $1 million per child. I'm in my 20s. I do want to, retire and kind of live a big life. And so the first thing I did was went to see my financial planner, and he carved out this traditional plan, which was put everything in a 401k. You've got kids, you can invest in 529 plans, and that's really, your path. And, running out the math at 7.5%, which is typically what the indices will do over time, it really wasn't going to move the needle for me. Right. So at that point, it launched me on this obsessive journey to figure out how the top 1% were actually building wealth. So I started investing in real estate, everything from raw land to single family to multifamily to retail to self-storage, getting into oil and gas. And this is back in 2000, right, when there weren't lots of different resources. So fast forward 20 years, had really good success being an LP, creating a strong due diligence process, understanding how to vet opportunities in the private space. And I really created Pantheon now so I could help other LP investors really figure out, how do you get, number one, access to great deals? How can you learn about some of these other opportunities you might not be familiar with, right, that they're not really talked about in Wall Street? And that's how I put my book together called The Holistic Wealth Strategy.
Gotcha. So when it came to, and again, it's one thing I love about talking to people, especially that cut their teeth in real estate, is, the stories are all kind of have a similar genesis, but the the forks in the road and the different paths are always kind of fascinating to look for. People like, I went out and I bought a rental property. I bought a piece of land I didn't know what to do with. Like I finally caught caught it, but what do I do now? And then, seeing that progressive, life cycle of where people go and then where they end up is really, really fascinating. Rarely do you kind of see that in too many other, professional, out, lenses, right? And using the word professional when it comes to real estate can mean a ton of different things, right? It's not just being a realtor, but from the perspective of the investor, right? So it comes to that point, you've kind of got this. And what was kind of the initial, funding any business? Like, what was the core focus of Pantheon when you started it after you had gone through this life cycle of being an investor and the LP on that everything?
Yeah,
Were you raising capital, or what kind of like what were you doing with that?
yeah, that's really a great question, and I see this very differently. I don't, there's all kinds of people in this space, Alex, doing lots of different things. But my approach was simply to try to solve a problem for the LP investor, for people that are tired of the Wall Street approach, just throwing the dice and just hoping you're going to, get average returns. It's all about, solving these problems which we have, which are number one, taxes are your biggest expense. So how can we reduce our taxes? How can we actually create passive income? So again, instead of Wall Street that talks about this accumulation theory and building for retirement, how about creating passive income today that you can live off of today? So investing in passive income type assets, right, that can give you that income, and then of course creating some legacy growth to that. So I really see this as what I call the trifecta of an investment return, where you get tax efficiency, passive income, and forced appreciation. And if I compare that to equities, for instance, I see that is very linear in nature. So if you own 100,000 shares or of Tesla stock, for instance, the only thing you're mostly hoping, unless you're a trader, is that it's going to go up in value, right? Well, with alternative assets, we can get this trifecta, right, which really reduces the risk to our downside and then multiplies the risk on the upside. So we really started with trying to help investors vet and identify exclusive access to these unique opportunities in the private world. We've built up a network between RIAs and family offices in institutional class type opportunities that we invest in that frankly most people just don't even know of, because that's how the private world works. It's just very, all these off-market deals, you don't want to go after something that's highly advertised, right? You want to get access to those things and then make sure someone else can help you with that vetting process and know that your, precious capital is going to be preserved. You're making the right decision, into these types of investments. So we really started, bringing these investments together with people. And now we've really expanded that into a virtual family office. We have a mastermind that helps educate people on these different concepts and how that can accelerate your growth. We also provide the cash value whole life insurance. The infinite banking strategy, we believe, is very strong as well. And we're actually developing, we have a software product that helps you manage and measure all of your assets together.
Gotcha. So yeah, a few things, definitely a lot to unpack there, but two things that you brought up that I feel are very important to look at are vetting and access, right? And to before we kind of get into the specifics of the questions I want to ask you on that, you really did kind of lean into something where it's the more visible stuff is not necessarily everyone can view it, but where do you find the margins and the value, right? It's going to be in the stuff that's a little bit harder to find. And one other thing I would just kind of put out there too is that especially in today's market, it's people again I think in large part are getting disenfranchised with the public securities market, and there's a lot of marketing and eyes on the private markets, whether that from being limited partner commercial real estate, whether that's debt funds, whether that's private credit, all these different things are starting to promote more, and hopefully they're doing it in good faith and with within the compliance of the SEC on how they're allowed to market. But I kind of give everyone a little bit of a word of caution, right? You're going to see a lot of these things that advertise a lot of, maybe you're advertising great returns, but always be a perpetual skeptic, when it comes into this stuff. If you're seeing an investment provider promote a certain rate of return or things like, hey, this is guaranteed or something like that, making sure you understand where your due diligence comes in and how to do it is of paramount importance, especially if it is in something that maybe has a little bit of a less regulatory lens on it, which again kind of leads me into the questions I wanted to ask you about vetting and access. Again, are two things that I hold very dear to my heart in my investing, but also what I encourage my clients to really, take a hard look at when it comes to the private side of things, when it comes to vetting. So, let's look at, maybe the vetting aspect first. What are some kind of key guiding principles that you really like to look at when you're going out and trying to help to identify things and guide people in this process? If someone's a little bit newer to the private markets, what are some things that you really like to do and you have used, your experience to build on to really help to vet some of these things?
Yeah, great question, Alex, and that's so helpful for investors out there. And let me preface this actually with my observation of the private markets, which I've never actually heard articulated anywhere. But after spending over 20 years in here, I would kind of really lay it out like this, right? There are institutional quality funds that are exclusive access, let's say it's with, Goldman or UBS, right? Some of the real, top wealth managers that they provide deal flow that's to their private wealth management clients that they can have access to private opportunities or certain RIAs that are operating independent, let's say of a Fidelity or a Schwab, one of the bigger type brokerage houses, so they can actually offer some private opportunities. Now, what's interesting is from a return profile, these returns, I would say, are generally in the nature of maybe 9 to 13%, maybe 14%, right? So the return profile is actually lower, but I believe that your risk is lower because you have someone like Goldman who's actually doing the due diligence on the sponsor, and it would be what I would call institutional type quality, right, in the private arena. Now, the minute you move into, say, something like a REIT, for instance, you're actually not in the private markets. You might be accessing a great real estate opportunity, but you're investing as a retail investor, so you're not going to see the tax advantages, right? You might not see that cash flow. The return profile is going to be even lower than that 9 to 13%. Then there's this layer below that, right, which is, I would say, family offices, RIAs, things like that, where a lot of the deal flow is what I would call invisible deal flow, where people in family offices like to do deals with each other, people that they know, and it's a very close-knit community. Now, if you can get access and get into one of these types of opportunities, a family office. For instance, we just worked on a medical office building project with a private equity group. It's a $1 million minimum investment just to get in. So we got in, but the GP, so the owner of this fund, he literally has 35 million of his own money in there, right? So that's a great sign, to answer your question, right, in terms of vetting, right? So now you have this other layer, and then the layer below that, I would call a lot of these people who have less than 100 million in assets under management. So they're promoting these multifamily syndications, all kinds of other syndications, and they're talking about really high returns. And I would be very skeptical about working with operators like that who don't have a depth in terms of their balance sheet is really important. They may not necessarily have the depth in terms of experience. How many full cycle projects have they actually done? How many cycles have they lived through in terms of economic cycles that they've actually gone through? And what is their level of their team? right? Like how good is their team? Because a lot of people in real estate, you can grow really quickly. And it might have been just, two partners who thought it'd be a great idea to kind of build a business. So they can show you a very attractive pro forma and making 20% plus returns and think that this is a great deal. But understand that you're taking on much more risk when you're working with that untested operator. And that's much lower than that institutional player.
Yeah, exactly. And everyone has to start somewhere, right? All these people that have $100 million under management, all start somewhere. And it's kind of a good example of something that's very easy for a lot of people to kind of wrap their head around is the risk versus reward, right? You have the inherently less risky, less return profiles of the more institutional stuff that might be on a UBS or a Goldman platform, and then you start to trickle down with the increasing maybe rates of return, but also increasing risk profiles as well. And one thing I would just kind of echo before we kind of get into looking at a few different things here is that especially on that last tranche that you mentioned, especially on making sure people are staying careful when starting to venture into the private markets is not only looking at how long they've been doing it and what their asset under management is, but you hit on a real key thing is that making sure and looking at how much skin in the game the actual sponsors of the deal have. One of the the things that I really am not too appreciative of on the kind of the marketing side of the real estate realm is the whole concept of I did all of this with no money. I used everyone else's money. I had no money in this deal, right? Which from you doing something might sound attractive, but if you're going to put your money with someone when these people are talking about getting money from other people, that maybe well, what reason do they have to operate in good faith if they have none of their skin in the game? So be careful of those things. And then also looking at, what they're doing, asking questions about cross collateralization. That's something I've been seeing come into the market recently, especially for the real estate realm with cap rates getting compressed, with interest rate markets doing what they're doing. Seeing some of these different operators maybe cross collateralizing different projects, maybe with different holding companies underneath of the same umbrellas. So they're some things are starting to occur that especially for that rung that you're talking about, people need to be very careful if they're venturing into that market. Can you do it with a degree of safety? Certainly, but it's going to take a lot more work to make sure that you're doing due diligence to an effective degree to make sure that you're staying safe in there. So again, to that point, again, I think people kind of understand how that kind of goes. So the point of access was the other part on this part of the question that I wanted to hit on. So again, if you're a private wealth management client, you'll get the some keys to the kingdom of places that'll open up some of these private opportunities. But those that middle rung we're talking about, kind of that intra-family office space, I think is kind of where you operate, if I'm hearing you correctly, on kind of trying to find access for how people can get involved in some of these other types of deals. Is that a fair point?
Yeah, that's correct. And a lot of these, again, are just kind of offered to institutions at a certain level. So, for instance, our oil and gas opportunity, one of the sponsors that we worked with last year, working with right now, the minimum investment is 10 million. Right. So they're basically accommodating family offices and RIAs that are coming in. But with certain relationships that I have in the marketplace. And then the way our model works is we're often creating a fund of funds type structure where we can actually pool we can pool investors together and then create our own fund and then, work inside of an opportunity, right, with a sponsor to be able to meet some of those thresholds and partake in that opportunity.
Sure. So would you be packaging something like that together in like an SPV or like a
Correct.
EST or something like that?
SPV. Yeah.
Okay, gotcha.
Yeah.
So from the perspective of that, that's kind of where you're bringing in that kind of bridge to that middle section. Now, big big thing that I'm a hence by working in the tax sheltered arena and qualified plans and things. Taxes are always something that is at the tip of my tongue. And when you mentioned tax efficiency, I got excited. So when it comes to kind of in being involved in some of these, SPVs that go into these different funds, from a tax efficiency perspective, again, the disclaimer is that, we can't give tax or legal advice, trust but verify. This is an educational podcast. With that said, what are some of the the advantages are things that people need to watch out for if they're going to be coming into these things from a tax efficiency standpoint, because different investments are going to offer wildly different treatments from taxation depending on how things are paid out and how you've actually deployed your capital in there. So maybe speak, that's a very broad question, but maybe speak a little bit to that on the tax efficiency front.
Yeah, for sure, Alex. I mean, the way I see it is investors should really start to get a clear picture. And I kind of talk about this in my book, which is really creating a crystal clear vision statement for yourself. And part of that is understanding your own investor DNA, understanding your own risk tolerance, and understanding your own goals. Right. So, this morning I was talking to a high income doctor who's paid by W-2. So he's paying a massive amounts in taxes, right? So for him to invest in something like an oil and gas opportunity, right, where he can offset his active income against that W-2 is highly efficient for him, right? So that's kind of part of his tax reduction strategy that he's able to leverage. Now, you might not be in that scenario. Let's say you're retired or you're self-employed and you might not have as much income, right? So, you can align to real estate, right, where you're taking passive losses against that passive income, which I'm sure you've talked through with your investors many a times, right? And understanding that. And also with potentially bonus depreciation coming back, in full swing. It sounds like it's going to happen. That's pretty exciting on the real estate side. So that would be pretty good. But there's a lot of really interesting opportunities I think investors aren't aware of. We were looking at one recently around a battery facility in Texas, where there are certain energy credits given out by the government. So there's also like energy credits you can get, especially on the infrastructure side. And then on the oil and gas side, people just don't realize these benefits have been around since really the Reagan era in the 80s. And we're really trying to support, the local producers of oil and gas. And people say, why are these benefits there? It's because they're all small operators. 80% of the industry are actually all small operators. And oil and gas supports, no matter what industry you're in, where you work in the world, it really kind of supports everything. The other thing that we really like about that asset class is that it's completely non-correlated to the markets, right? And it has really strong macroeconomic fundamentals, meaning that, there's always kind of lack of supply and enough demand. And you think about, we try to make investment decisions, right, where the puck is going. So think about the AI demand on energy is just massive, right? It's exponential right now. We don't have enough power to do that. So we want to leverage things like oil and gas to be able to do that. I know that's a strong bet for the next 10 years. As much as we love all of the green initiatives that are coming out, we're just not there. We're a ways out, right? So we like that as a big tax strategy. And also I would, point out that just focusing on taxes is actually where it all starts, because you have to get educated on what's possible with taxes. So I'm sure all of your listeners have read Cash Flow Quadrant, right, by Kiyosaki, and you understand that, you as a business owner or an investor, that's where you're going to pay the least amount of taxes. So I would simply state for people to have a kind of a clear parameter here, if you're a business owner, you can get your taxes down to 20% or less. If you're an investor, you can get your taxes down to zero. So if you're paying anything more than that, you're likely paying too much. And what's happening here is that you have to make that paradigm shift to understand that you are actually partnering with the government, right? It's not about taking advantage of loopholes. It's understanding and being educated in how tax law works and saying that, hey, I'm going to partner with the government and invest in multifamily real estate because the country needs real estate, right, in certain markets. So that's why we get these tax incentives. So if you can start to align, right, your investing with the incentives and partnering with the government, just think about that. If you could decrease your taxes by 10% a year on top of a private investment that could make you 15 to 20% a year, right? Now we're talking, much bigger numbers. right? So taxes are huge.
Yeah, and also playing with that thing that I always tell people to look at. Get a financial calculator or a compounding interest calculator. Just Google it and start playing around with ones that'll give you an effective tax rate and a time horizon. It's really eye opening. But you did mention some things I do kind of want to pick apart a little bit because we haven't really focused on the oil and gas aspect a whole lot, and there's a few points I want to make to the real estate side as well. But I really do agree with you on the point of saying, look at where your goals are. Is it and your current status too is saying, hey, look, I make X amount of money. Here's my effective tax rate. If I were to replace X amount of income with income from this, is it a better or worse tax treatment, right? You can reduce cost by a significant margin. If you look at the taxes, I think there's a little bit of an easier, lower hanging fruit than almost anything else when it comes to investing, right? You look at the perspective of, hey, what is this paying out? What's the tax treatment of that? How am I deploying that? And at the end of the day, what's my spread on how much I'm paying in taxes? It's a little bit easier to say, well, this asset class is X, this asset class is Y, here's what I'm currently making, here's how it can affect both sides of that coin. And you can really start to make some significant gains without even really changing your performance profile, right? Assuming everything is a status quo, then, again, you can make a lot of interesting moves with just taking into account what asset classes you're investing in and what that treatment of that income is as it relates to where you're making money in other places. Now, the oil and gas aspect is something that I think people is often overlooked, especially for people that might be higher W-2 wage earners, in the fact that you can utilize those gains to offset your ordinary income from a W-2 job. A lot of people talk about the real estate aspects of things like bonus depreciation, cost segregation analysis, additional things that are going to be passed through. But you can only offset, I believe it's $2,000, maybe $3,000 of ordinary income per year from passive K1 income sources, whereas oil and gas does pass through to offset with the depreciation and the write-offs that come through that. Now, are there any types of structures that people are looking to invest in oil and gas that would block some of those benefits coming through? Or is it kind of just depending on, what structures, like what kind of structures will offer that kind of ordinary income offset to people if they're looking to get into the private oil and gas markets?
Yeah, well, one really important distinction, unlike any other syndication, say in real estate, would be that you are actually a GP when you sign your subscription documents versus an LP. And that's how you're able to be an active partner. So therefore, you get the active losses. And those active losses come from the intangible drilling costs, the depletion costs, and all of those can be tied directly to you, right? So you will be a GP typically in the deal for, I would say, maybe the first year or so, maybe a little longer, depending on how quickly all of the capital is actually deployed into the ground. And then, most operators will convert you to an LP standpoint. So some people, you have to think about maybe there's some additional risk, as you coming in a GP, something to kind of think about and making sure the documents are fully vetted from your standpoint. The second thing from a vehicle standpoint is I would likely not recommend, using your self-directed IRA to invest in something like oil and gas, right? Because you're not going to be able to get that active income offset right through that. So if you have cash, that would be the ideal thing to reduce your overall W-2 active income from that standpoint. And I would look at, putting other assets into your self-directed IRA.
Yeah, for sure. That's a really great point too. Is as everyone that's consuming this podcast know, we're a self-directed IRA custodian. So I like to kind of promote a large breadth of different investment types. But looking at the practical aspect of what some of the benefits are from the taxation standpoint can always drive what makes good sense to put into a self-directed IRA versus not. And not everything's going to be just as equally beneficial, right? If you have something that gives this big juicy benefit of, tax benefit, it might have a solid, track record, the performance might look good. But if you can help to, again, reduce your personal income, unless you are simply, all passive income, type of person, or maybe retired, like that's a very big benefit that you might inherently lose out on because unfortunately, any type of write-offs, depreciation, or benefits from a tax efficiency standpoint that an IRA investment might be that the investment might be spitting out does not pierce the veil and go through the IRA into the individual personally. Another big misconception that I have to unfortunately deflate some people's thought processes a little bit on is that one. As much as I would love for it to be the case, unfortunately it isn't. So again, to that perspective of the oil and gas, one interesting thing that you said though is it always structured as a GP position, or is that the instance where you would get that, or is there kind of again a variety of different ways that these investments are packaged? So where that if you want that tax efficiency from a personal standpoint, you need to make sure you are investing in a GP position, or is that the commonality factor for these types of
That
investments?
is the commonality factor. You
Okay.
do have to be a GP because again, that's how the tax code works, is to be an active investor as the GP. That's how you will get on your K1 statement. That's where you will see the tax offset of active losses, which are basically paper losses that come through on your K1. Versus if you look at a K1 from maybe your real estate deal, you're going to see the passive losses block, checked off. But now another thing for investors to think about, and again, same point as a disclaimer, I'm not a CPA or financial advisor, but this is some thinking you might want to do, right, in terms of strategic planning. So if you have a self-directed IRA and let's say you're taking RMDs, or you're starting to liquidate it, right, for capital in certain years, well, you're paying ordinary income rates on the income that you're taking in that year. So that could be a great year that you pair some of that income with an investment into oil and gas, which would offset those taxes.
For sure. And another interesting perspective too is that if you have, depending on how things are structured and the way it goes, if you had an oil and gas investment within a self-directed IRA doing potentially an in-kind distribution, depending on what the payout schedule looks like, then taking that as a personal asset and utilizing the income to help offset the ordinary income of that taxable distribution, a lot of interesting and creative ways to kind of frame this stuff out, which is the aspect of my job and where I operate in the investment stack that I really enjoy is that creativity aspect of it. But exactly right, looking at not only what your ultimate goals are, but where you currently are in life and understanding some of the triggers around whether it be retirement and having to draw down retirement plans, or just what your current goals are and how your tax situation may change. Again, if you really like, if you're not the biggest proponent of oil and gas, but the benefit of it really helps to offset that income, and then you retire and you have little to no ordinary income, then maybe everything's passive. Then maybe looking at a shift more towards the real estate side, where it can help to offset much more of your passive income. But again, it's all a balancing act, right? It's not saying, hey, you should just fire sale everything and do everything into one. But again, understanding that there are rebalance points and different things in life that really are going to kind of drive what your portfolio balances could or should be to help best get you to where you want to go is something that I don't think a lot of people really take to heart, right? We're kind of forced into this aspect of thinking, well, I set it and forget it, right? Like I'm looking at a target date fund, or I'm just going to ride the S&P 500 indexes until eventually I'm in a pine box 6 feet under, right? Looking at this thing as a living, breathing organism is a key point that I really want to hammer home, and I try to as best as possible with this podcast is to tell people, keep thinking, be a lifelong student of this stuff, not only from just learning new things, but also understanding that different points in time in your investing career and also your life necessitate a little bit more of a forensic lens on what you're doing.
Yeah, I mean, I would be very clear to investors when you start to put all these strategies together, you can completely 10x your outcome versus the traditional path of,
Mhm.
7, 8% return in equities. And I can even give you a high level scenario here,
Sure.
right? So
Go for it.
let's say you took just 100K, right, as a basis, and that was sitting in S&P doing 7.5%, right, over the long haul. So for the next 20 years, that would actually compound out to about 380 some odd thousand right there. But you have to not forget about taxes, fees, and inflation over that time, which is often misunderstated by a lot of these institutions that they don't really cover that, right? So that's there. Now, if you took that same 100 and let's say you even paid taxes on that, right? You took it out of your capital account, you had taxes, you paid 35% in taxes. Let's even bring it to 45% in taxes. Now you have a net investable 55K. And you say, wow, when am I going to break even? Well, you'd probably break even in about 3 to 4 years. But if you were compounding and you were in syndications, let's say, that could earn you 20% rate of return, that were totally tax efficient and compounding, you'd be over 2 million at the end of 20 years. Right. So that is the power of compounding, tax-free compounding, and being in some of these private assets. And, it's not to say that you should put all of your eggs in that basket, but just considering how private investments work. And it's no wonder, right? Like organizations, for instance, Tiger 21, right? They have 1,300 members with average net worth is over 100 million. I've had the CEO, Michael Sonnenfeld, on our podcast, and we talked through asset allocation, and they literally only have 22% exposure in public equities. And so what does that tell you? Right. So the best of the best in terms of investors are not putting this traditional model of 60-40 into stocks, bonds, mutual funds, and then just hoping that, you're going to grow.
Yeah, exactly. And it's interesting from the point of view of just how much more stability you can get, and when you're investing in things that don't have a trading frequency like you see on the stock markets, right? And that kind of the nature of the markets themselves, whether it's a correlated, non-correlated to correlated asset, it's still all traded on the same marketplace, right? So something happens that affects one part of it, well, it can certainly affect the rest of it to a certain degree. So again, the stability aspect is something that is definitely nice to look at, because when you have only maybe 1 or 2 steps to a tangible asset as opposed to really no steps to anything tangible with a publicly traded stock, there's some really real big benefit to look at that, as far as kind of, is it, I know we use the word tangible and intangible here, but there is kind of an intangibility to that benefit of having that tangible backing, maybe only 1 or 2 steps down the stack to what you're actually investing in. Again, whether that be real estate, whether that be a pump well, again, something else that you can actually get to the ultimate product and investment that quickly through that vertical is a very important thing when it comes to, again, kind of driving that ultimate goal that you're looking for. Now, my next question to you, again, we kind of, I love tax efficiency, and I get excited when talking about it. Don't want to put anyone to sleep behind the wheel if they're driving, listening to this, by talking about tax efficiency the whole time. But the other thing that you mentioned is forced appreciation. Now, that can mean a lot of different things to a lot of different people. But from your perspective, when you're kind of helping to guide people and when you're looking at your investment philosophy for this, how do you try to achieve forced appreciation in your strategy?
Yeah, so forced appreciation, this is a very important distinction, right? Is that a lot of people, especially all of us, own houses, right? And we just kind of think as our primary house, well, the house is going to appreciate over time, right? And so it's an asset, it's just going to kind of go up over time. Well, if you have, for instance, a multifamily apartment building or a self-storage facility, right? You can actually own and operate that tangible asset and drive value into that. So you could put in a pet park and now start charging $75 extra a month to increase your net operating income in that asset. You could install electric charging stations, into the whole facility, right? And then start increasing the rent. So this is what I mean by forced appreciation, right? Where you're either creating some innovation, you're maybe doing, fixing and redecorating and renovating of different units to drive up the value. And how value works in real estate like that is it's all about the net operating income, which is basically your total revenue that's coming in from your gross potential revenue that comes in from clients minus your expenses. And then you have your net operating income, which is how the property is actually valued. right? So that's a great way to actually force appreciation in it. And it's no different than any other business that's out there where you can, businesses are always trying to grow by becoming more efficient and things like that.
Yeah, no, and that's a good point because I think people, from the basic perspective, especially the nice thing about real estate is that you can say, okay, well, I do X or Y to a piece of real estate, it's going to increase the appreciable value of it, right? But a big part of anything, especially if you're getting outside of the stock market, is focusing more on a cash flow. Like, how much is this going to spit out to me? Especially when you're dealing with less liquid assets, right? You have to be looking at more of a cash flow model to say, hey, how's this going to be spitting out income to me? And we covered, the perspective of tax efficiency, but also how can you increase that cash flow by forcing some type of appreciation factor into that? Again, real estate kind of an easy one to look at. Now, are there any other avenues from different asset classes that you enjoy that have the ability to have some type of forced appreciation to them?
Yeah, so basically, in our investment thesis, we focus on energy, real estate, and then the third one is private credit and private debt. So we really like this private credit space. It's actually been growing 20% annualized over the past 20 years. And think of it as that there's lots of different segments inside of private credit, but the one we've been having a lot of really good success with is merchant cash advances. So I live in Florida. I know you do as well.
Oh yeah.
So let me give a great example of how this kind of works, right? We had, unfortunately, some of these big hurricanes that kind of came through here last year, but you've got a small business owner like a roofer who says, I've literally got 2 years of backlogged work that I just cannot get to. I don't have enough people. I don't have enough trucks. I can't buy enough equipment because my credit line is full, right? So he might need, let's say, $300,000-$400,000 loan to be able to access some of that additional revenue. Now, if he goes to the bank, he might not have necessarily been to college and all these things, the roofer, right? And it could take him 6 months to kind of process that. Well, through our advanced underwriting, right, we can actually get him money very quickly, get him underwritten, which is typically collateralized against his equipment or any other assets that might have. So he's funded inside of a week, and now he's going to pay back basically principal and interest on a daily basis. So literally, as revenue is coming in from the clients, like the merchant cash advance actually gets paid first, right, before the business owner does. Now, this is a win-win environment because he gets access to that capital in a painless environment. He's paying a very high interest rate on that, but otherwise he would have never really received that revenue. Now, as the investor, what's beautiful is, again, you're getting income is literally coming back to us on a daily and weekly basis that then can be recycled into the next opportunity to be lent out again. So the amount of velocity that you have in this is just phenomenal. We've been working with one of the top sponsors actually in the country that does this like really well, like clockwork. It's all institutional quality, and we have a structure where it's paying out very strong cash flow returns or some growth returns as well. And it's a completely, again, non-correlated asset class to the stock market. And provides that really nice cash flow for you. And a great example, Alex, too, is how people are leveraging this is the perfect opportunity in a self-directed IRA, right? So I would look at SDIRA money if you're in the indices in some shape or form or another. I mean, let's just say you're making 7 to 8%, right, on that. Well, in our growth class, you could actually be tripling that return. Right. So you could actually reduce your risk by getting outside of all of that, market correlation, and you could be in this new asset class that's just churning over cash flow, and, just really exponentially growing your account.
Yeah, absolutely. Now, for the private credit stuff that you normally like to look at, would that be basically just paying out income that would be treated as interest income, or would it be
It would
treated?
be interest
Okay,
income, correct? Yeah.
gotcha.
There's no tax efficiency on this, the way it's structured.
Yeah, which again, for things that have like little or no tax efficiency, utilizing something like a tax shelter like an IRA or something Definitely something good to look at. Now, excuse me. From the perspective again, a little bit on this private credit. So, the merchant cash advance again is something that I haven't ever really talked to anyone about. I've talked, several different people about private credit in different forms and fashions, and one of the things I really like about it is there's so much. Kind of innovation going on in this industry and a lot of different places where you can get into new segments of the market as opposed to people have been drilling for oil and gas for over 100 years, right? People have been investing in real estate in some form or fashion since the Romans, right? So there's a lot of kind of maturity in a lot of those markets and how they're run and how people put things together. But private credit has been something where I've been wholly surprised by all the different avenues that are out there for people to kind of create more efficient markets for people that need money, right? Because just like you said, that roofer that can't, get through all of the business that he has, going to the bank might take them, I don't know, 3 months to get something. If they're going through the SBA, maybe longer. So, from the perspective of kind of what you're seeing in the private credit market, again, the merchant cash advance, I think, is something very, very interesting. But are there any other avenues that you're seeing that are of particular interest to you in the private credit space?
It's interesting. There are some small niche segments. Like we've been kind of talking to one sponsor who has a real niche around actually defense contracts and providing credit, from that standpoint. So all of these things are backed by the government, right? So they're super solid in terms of how they go. But I think if you just think about private credit overall, right? You know, basically lending and banking has been going on for well over 100 years as well, right? It's been out there, but this private credit is really banking being disrupted is what it is, right? And being able to provide, innovative type of structures for lending to, businesses that, are scaling and need it, right? And of course, the other interesting thing about that you have to really be cognizant of is default rates and, not lending to businesses that can't handle it, right? So over 8 years now, we've been actually tracking at less than 7% default rate. So it's extremely low, especially when you look at this on an asymmetric basis in terms of, the yield that you're getting as well as, the default risk. So there are certain sectors I think you can look at in private credit. We've really liked this merchant cash advance. One point I would also, maybe caution listeners to think about right now is there is a lot of movement in private credit and private debt right now in the real estate space because there is distressed real estate. So those equity holders are getting hurt on those projects. And now they're moving in like pref equity or credit, right? Lower on the stack, right? That they're able to get, better terms on those deals. But overall, that asset is still in distress. And I think some of these people are marketing it as though, hey, it's real estate, right? It's the tangible asset that we know is so strong and things like that. Well, there's a lot of distress in commercial real estate right now, right? With deals that are underwritten in 2021 because they were using floating rate debt. So
Yeah.
if you're trying to diversify your portfolio by getting into private credit, if you get into private credit with real estate, you're not really diversifying. You're just using a different part of the capital stack.
Yeah, exactly. And to that point too, I know a few people that operate, some private credit funds that focus on pref equity for those types of deals, and it's one of those things where they made the decision to go that direction because of that, and whenever you look at any market, whenever there's distress, there's going to be opportunities for returns to be made. But again, you're going to have to look at that risk profile of what you're kind of willing to take on. If an operator is needing to give up something like pref equity for bridge debt or some type of private credit market because they can't get it from Fannie or Freddie or anyone else, or maybe it's a real tight time horizon. Is that juice worth the squeeze? And making sure you really understand what kind of is going into that market is very important. To kind of scale back a little bit on the private credit side of things, though, is also one thing that at least on the merchant cash advance that I'd be interested to know about is that normally I kind of look at some type of metric of loan to value, right? I talked to the people over at BIP. It was a fantastic conversation with them on the private credit where they operate in doing secured lending against private stock of pre-IPO companies, but at a very favorable loan to value ratio, where they kind of come in as partners to help guide through the last hurdles of process for capital allocation, whether it be for like patent approval, drug approval, and things like that to get people into that next level for their companies, which I found interesting. But again, easily identifiable loan to value. Lending on real estate or some type of structure like that, easy to kind of identify that LTV when you're doing these loans. From the merchant cash advance, though, how do you kind of weigh the factor of what you're lending out versus what the ultimate value on a secured interest might look like?
Yeah, that's a great question. And frankly, it's all like so unique. So the entire fund that we kind of, work off of, we're literally invested in almost over 15 different industries, right? So lots of businesses in different, shapes and sizes. So there is unique kind of underwriting models that are actually totally proprietary based on that specific industry, based on that specific business and how it works. And then the other thing that's really kind of interesting, right? So if you think about it from kind of a diversification and a hedge strategy is, again, number one, we're not exposed to one sector at all because it's across 15 to 20 different ones. And then we also never take more than a 5% position in any given one. So therefore, we really minimize the exposure if there is any kind of default or anything like that. But the underwriting really kind of proves itself in terms of managing to that less than 7% default rate. That even includes throughout the pandemic as well.
Yeah, and I would assume also some of that underwriting risk mitigation is also, uh, kind of driven also by, you mentioned it's a much more like a much higher frequency of repayment and cash flow to it as well. So that probably plays into a little bit instead of just like saying, okay, well, there's a monthly payment, it's principal and interest until repaid or with a balloon or something like that. I would imagine that, again, speaking to that frequency, it also is kind of part of that underwriting process that's a little bit different from like a traditional loan to value underwriting process that plays into that. Is that fair enough to
Yeah,
say?
correct. The average life of an MCA is about 7 months.
That's fast.
Yeah.
Um, but like, how would it be like? Would these be structured as loans? That's something like, I mean, there has to be an end date to it. Is it normally structured as like a 12-month period with a balloon at 12, or is it just a floating repayment schedule?
Yeah, it's more of a kind of a floating repayment schedule, and
Okay.
and then a lot of them again are somewhat unique based on, the industry, the business, what kind of terms are there. And a lot of the business is actually repeat business,
Hmm.
right, with clients. So therefore, clients are always expanding, right? And they're just looking for capital, and this is a quick source of capital to really fuel their growth. And again, you just don't have to deal. If anyone has had to deal with the complexity of a bank, it's almost like having an IRS audit, when you try to apply for funding as a business owner, right? So this is really providing that, alternative solution. People can get capital quickly, realize that value. And again, these are businesses that are growing, not businesses that are, desperate, to kind of hang on because they wouldn't make it.
Yeah, it's to that point that you make, it's the roofer that has this huge backlog of people that he needs to get roofs on, being in Florida, as opposed to, the roofer that's saying, "Hey, I need more money to be able to market my business because I have no leads." Kind of as the avatar of who you're taking in on the private credit side, right?
Yeah,
Yeah.
exactly.
Awesome. Well, again, kind of getting towards the end of this, I mean, I really have certainly enjoyed talking to you. I mean, it's anytime we get to mention tax efficiency, I get super excited. But again, kind of the strategy you talked about, I haven't really had someone kind of break down, kind of the stack of where private equity lies, right? From the institutional side to the family office to the other side of it, as well as kind of how these things can work for the strategies of tax efficiency and what you actually need. Again, phenomenal conversation. If people are interested in learning, or I should say, last question, anything that we haven't kind of covered in our topic of conversation that you really feel is a germane point that needs to be out there before we bring this in for a landing?
Yeah, I think just the last point, Alex. I mean, we really got deep into, some of the strategies, some of the asset classes and things like that. But, to me, it really all starts with really investing in yourself and getting clear on, your vision, right? Really understand what that looks like for you because it looks different to everybody else. And once you have a clear picture on that vision, that's how you're able to kind of break down doors. You can be, positioned the right way. It's kind of think about it as like Google Maps, right? The only reason Google Maps works is because you know where you are on the map and you know where you're going, right? And then you have a clear path to get there. But if you don't have that clear distinction in terms of where you're going, it can be so much more challenging, right? There's so many different things we can invest in, so many different possibilities and everything. So I encourage people to just really get clear on what their vision is, which is really kind of what starts this all, and then starting to look at how can you make investments in yourself, because you are your greatest asset. Right? And oftentimes we're using financial capital to grow our other forms of capital, such as human capital or intellectual capital or emotional capital, right? So how can we, use that financial capital, in the most judicious way to really live that meaningful life and really get to the goals that we have planned for ourselves?
Awesome. I think that's a fantastic way to end this up. If people are interested in learning more about you, connecting with you, also, I know you've written a book as well. Where can they find that? So how can they connect and where can they find your book?
Yeah, sure, Alex. I wanted to give out a free copy of the book for your listeners. You could just go to holisticwealthstrategy.com and you can get a free copy of the book there to learn more about some of these strategies, or feel free to, check us out at pantheoninvest.com.
All right, fantastic. Well, again, I really appreciate you being on with us. Excuse me. Our most valuable asset we all have is our time because we can never make any more of it no matter how well we invest. So thanks for taking a few minutes out of your day to speak with our listeners today. I really appreciate it. With that said, my name is Alex Perny. This has been another edition of the Alternative Investing Advantage podcast. We will see you on the next one. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.